What's up, guys? So I've been seeing this ad all over social media, mostly on Facebook. I'm gonna post the ad right here, and it's talking about this new investment opportunity called angel investing. And it's supposed to be this amazing opportunity with crazy returns. We're talking 100,000%, 500,000, a million percent returns. So it has the opportunity to make you rich. Right? So, this is right up my alley, okay? Because this is a investing entrepreneurship channel. And I have roughly a decade of experience investing in public markets and a few years experience starting and growing businesses. So I have the fundamental understanding of how angel investing and venture capital works. So, this piqued my interest. I was like, all right, let's see what I can find out. Let me do a little bit of research. And if I see anything interesting, I'm going to post it on YouTube, see if I can provide any value if anyone else is out there seeing these kind of ads. So, I decided to look into this and let's see what we could find out. So for us to understand what angel investing is, we first must understand what the life cycle of a business looks like. This chart is a simplified model of the different phases in a business's life. In the beginning, there's the startup phase where the founders and their team brainstorm and work to create a prototype of a product or service that they want to sell. In this stage, the company is only spending money to build out the product and systems and not earning any money from sales yet. That's why the cash flow and profits are in the negative. Then once the initial line of products or services are ready to go live on the market, the business enters into the growth phase. At this stage, the focus is on growing sales and market share as much as possible, with any profits made getting immediately dumped back into the business in order to finance increased capacity and thus continued sales growth. The partners of the business get to decide how long they want to stay in this phase based on their goals. If they want to achieve a certain yearly revenue number, then start to take profits, they can do that. Or they can grow as much as possible until they've saturated their market and the law of diminishing returns kicks in. That's when the slowdown phase starts and the sales growth of the business decelerates significantly, either through natural market forces as the business model reaches maturity, or it slows down intentionally as the shareholders decide to lower their investment in sales growth. Once the sales growth slows down to that of the overall market, then the business enters maturity, also known as the cash cow phase. It's called the cash cow phase because that's when profits are less so reinvested into the business and more so distributed to the shareholders. For example, if the business has reached maturity and is doing roughly $100 million a year in sales with about $20 million in profits, and let's say there are 4 business partners, each owning a quarter of the company's shares. They could decide to distribute all those profits to shareholders, with each getting a distribution of $5 million that year. Now, if the business partners are over here making all this money, don't expect others to sit idly by and not try to take market share from them. If they don't have competitors already, they soon will. Now the business can go one of two ways when the competition starts to heat up. They can either evolve by upgrading their product line and introducing new products, or they can just decline and lose market share. A great example of a mature company evolving by upgrading their product line and introducing new products is Apple. Founded in 1976 and established in the computer hardware space for decades, they successfully got into the phone market in 2007, the tablet market in 2010, the wearables market in 2015, and so on. Now Apple dominates several large markets and is the first company to reach a $2 trillion valuation. As for mature businesses that declined in the face of competition, there are too many to name. BlackBerry, Circuit City, Blockbuster, Sears, Borders, Toys R Us, the list goes on. Anyone that knows anything about investing knows the strong correlation between risk and reward. High risk, high reward. Low risk, low reward. Now let's look at this chart of the business life cycle through the lens of risk and reward. As you can see, the business risk is higher the younger it is, and thus risk is highest during the startup phase. Then it goes down parabolically until market maturity is reached. This chart also shows the inverse correlation between how the business funds itself with debt and its risk level. The reason debt is inversely correlated to risk is because when you loan money to someone at a certain interest rate, your only concern is to get paid in full. The business you lend to could barely scrape by, or it could be wildly profitable, and that won't change the amount of money you make as a lender. So your only concern is to minimize the risk of non-payment. That's why in the early stages of a business, funding the operation with debt is usually not a good option or even possible unless you provide collateral against the loan. To get around this inability to use debt funding during the startup and early growth phases, money typically needs to come from offering equity to investors. These are usually angel investors during the startup phase, venture capital funds during the early growth phase, potentially an IPO offering shares on the public market further into the growth phase, and debt is usually used for any capital needs once the business reaches stable profitability and market maturity. This risk to reward dynamic is why angel investors and venture capitalists make more money from investing in successful companies than you or I could by purchasing their stock on the public market. They get to invest before we can and potentially make more than we can, but they also take on way more risk than we do. This privilege of investing in businesses before their initial public offering as an angel investor or venture capitalist used to be reserved for accredited investors. An accredited investor is defined as someone with a net worth in excess of $1 million or an individual whose income is over $200,000 or a couple whose income is over $300,000. According to the SEC, only 10% of households qualify as accredited investors. The intent of this law is to limit high-risk investments to people who can afford the potential losses. Then in 2012, President Obama changed this when he signed into law the Jobs Act. Title III Regulation CF of the Jobs Act expanded options for entrepreneurs to seek out non-accredited investors to raise capital through online crowdfunding platforms. These new rules went into effect in May 2016. Even though this allows virtually anyone to be an angel investor, there are limits on how much unaccredited investors can invest. For those earning less than $100,000 per year, no more than $5,000 can be invested yearly. For those earning between $100,000 and $200,000, no more than 10% of their gross income can be invested yearly as an angel investor. The intention of these rules are to allow everyone access to angel investing while still providing some financial protections. All right, so now that we're on the same page about the fundamentals of angel investing and we understand the risk to reward profile of this type of investing, as well as the new laws that have changed and opened it up to the public, we currently have the tools to analyze any kind of ad that's trying to market us this dream of getting rich quick as an angel investor. So the ad that caught my attention the most is by this company called Angels and Entrepreneurs. And it caught my attention because it's being promoted by some pretty big names. Neil Patel, he's a leader in the SEO space. Anybody that has a website or an online business is familiar with search engine optimization. And he's pretty big in that niche, as well as Robert Hergovich, who is, his claim to fame is being a shark in Shark Tank, and also a self-proclaimed millionaire stock trader, Timothy Sykes. Anyway, yeah, let's check out the ad and we can see if this opportunity is legit.
Welcome to the Angels and Entrepreneurs Summit. I'm Mike Ward, and joining me for this historic event are Robert Herjavec and Neil Patel. Gentlemen, welcome.
It's a pleasure.
Glad to be here, Mike.
For hundreds of years, a secret market has existed where the wealthy and powerful gain privileged access to the most lucrative business deals the world has ever seen.
So notice right there, he immediately says, so for hundreds of years, there's been this secret market that the wealthy and powerful have had exclusive, privileged access. So those words were chosen very carefully. What they want to do right there is a psychological tactic where they want to say it's us against them and I'm on your side. They know that the average person that, maybe they're not too happy with their life situation, they don't ever want to blame themselves for anything. They don't ever want to say, yeah, I'm in my shitty situation because of stuff I did. They want to blame other people. They want to say, oh, those top 1%ers, they got their way that way because they have this privileged access that, to these super secret tactics and investment strategies that make way more than we can. And if only they shared us those secrets, we'd all be rich. They don't want to blame it on themselves. They want to say, hey, this person's doing better financially because, maybe they're smarter or harder working or put in more effort or have specific talent. No. They want to believe in this narrative. It makes them feel better about themselves. And these internet marketers know this. And it's funny how he immediately takes advantage of this. So anyway, just something I noticed.
And in doing so, they changed the course of human history. Now, around the dawn of the 20th century, J.P. Morgan invests in Thomas Edison. Edison's light bulb would soon illuminate homes, businesses, and cities from coast to coast. And Morgan's windfall would help launch the iconic company General Electric. A few years later, Cornelius Vanderbilt invests in two brothers, Orville and Wilbur Wright, who ignited an era of flight that would eventually usher in the age of space travel. Without Vanderbilt's investment, the Wright Company would never have become part of the $249 billion aviation firm Boeing. Now, fast forward to 1968. Using this secret market, Silicon Valley pioneer Arthur Rock invests $10,000 in a little-known startup. It was developing the processors that would transform personal computing. That startup, it was Intel, and Rock's investment made him a billionaire. Less than a decade later, another man who became a millionaire from Intel backs a brash founder whose own legacy will stand the test of time. That angel investor, Mike Markula. That founder, Steve Jobs. And his Apple II personal computer launched America's first $1 trillion company.
So this presentation is a little bit dated. Apple's now worth around $2 trillion. But those people they mentioned, Arthur Rock and Vanderbilt and J.P. Morgan, these aren't just random schmucks. Okay, they when you're an angel investor or a venture capitalist and you initially partner with the company, you don't just give them your money and then walk away and say, hey, give me 1,000,000% return in a few years. They're partners. They contribute. It's an active investment. They invest it. They also contribute their expertise. They contribute their resources, their connections, their knowledge, their experience. They're literally partners, okay? They might not be doing the day-to-day activities. It's way more than just cutting a check and expecting crazy returns.
Now, in 1980, when Apple IPO'd, Markula's shares were worth $203 million, a return of 220,552%. In the decades that followed, the rich continued to use the secret market, securing stakes in the hottest startups long before they IPO'd, long before Amazon and Facebook became household names. Now, the average American was locked out of these life-changing deals, but not anymore. A powerful congressional act has now unleashed one of the biggest financial shifts in U.S. history. Finally, everyone can capitalize on this secret market, where startups go from obscurity to being worth billions of dollars in the blink of an eye, where one deal can transform a small amount of money into millions, and for some, even more. The next Alibaba, the next Uber, the next Google, they are out there. And now two of the most successful angel investors in the world are going to help you find them. Robert, you're the founder of the Hershovik Group. You're a cybersecurity firm that generates $250 million a year in revenue. But that's not why most folks know you. You also star in the Emmy Award-winning TV show Shark Tank.
Unbelievable, isn't it? Never in a million years do we think a show about angel investing would become such a hit.
it's pretty clear that you tapped into something. I mean, people have wanted to get a glimpse inside this world of angel investing. It's exciting, a little mysterious. They're constantly seeing stories about this person or that person making an absolute fortune from some unknown startup suddenly becoming a household name, like Uber, Airbnb, SpaceX, or Bird Scooters. And when you look at all the money flooding into these deals, it's astounding.
It really has become a craze. Back in 1995, $8.1 billion was invested in startups. Early 2000s, you're looking at a little over $15 billion. Now, it's $99.5 billion.
And Mike, that's just in the United States. You start adding in Europe, Asia, you're over $204 billion.
But even with all this buzz, a lot of folks still aren't exactly sure what it means to be an angel investor or how to become one.
That's why we're here.
We've got a lot of ground to cover today. For the beginners watching, we're going to discuss Angel Investing 101. We're going to talk about how much more lucrative it can be to back startups versus stocks and how easy it is to get started. We're also going to talk about the risks because these are speculative investments.
They absolutely are.
So what he did right there by briefly mentioning these are speculative investments, these are risky, is called CYA, cover your ass. Now they have to do that for legal reasons. It's sort of like a fine print at the bottom of the page where they know that the vast majority of people, like it's just a fact, the vast majority of people that engage in angel investing are going to lose their money. They're not going to make any money. They'll probably lose all of it. So they have to cover their ass by saying, hey, it is a bit speculative. So, results may vary. Read the fine print. Do your own research. But anyway, yeah, so that's a tactic. You see this everywhere. You see this with fake gurus. I'm not saying these guys are fake gurus, but you see this everywhere. They sell you on the dream for 99% of the presentation, and then they spend 1% of the time going, yeah, it's a little bit risky. You might want to watch out.
That's why you've developed your 1000X formula. It helps determine whether a startup could shoot up 1000X or whether it just goes up in flames.
But that's just one piece of the puzzle, Mike. That formula is only effective if you can get your hands on the hottest startup deals. If you wake up one morning and you decide that you want to become an angel investor, that doesn't mean the next Airbnb is going to knock on your door begging you for money.
So Neil, that's why you're going to share your #1 secret for finding billion-dollar deals. And you already have the scoop on 2 angel deals that made the cut.
We do.
Well, let's jump right in.
All right, so now you get the point. They want to say angel investing is this amazing new opportunity. They showed you the percentage. You can make hundreds of thousands, millions of percent return on your money. And now it's open up to the public. You should definitely give it a consideration. That's what they're trying to sell. So, you don't see it in this. This is a much longer presentation. I'm not going to show the whole thing, of course. Ultimately, I did some digging. I was wondering, what's the pitch? What are they trying to sell us? And it seems like on their website, they're selling different tiers of access to their network, their Angels and Entrepreneurs network. And ultimately, the top tier with all the access is going to cost $5,000 a year.
Damn!
And that's payment up front, no refunds. So you're locked in for a year. So besides the fact that there are plenty of platforms that don't charge you nearly as much of a fee because they don't have to pay for a yacht and celebrity endorsements and all these marketing costs. Well, before I give you my opinion about it, I wanted to share with you the opinion of one of the best angel investors of all times, Jason Calacanis. And he's been verified by Forbes, over 100 million net worth, and he has decades of experience successfully angel investing. What he thinks about it. So here he tweets, "Totally not a scam. Send these guys all your money so they can help you make all the money. And if people are promising to make you rich as an angel investor and they don't have any successful angel investments, you should run." He also posts this video.
They've joined forces for something that is going to blow your mind. Neil, this is so exciting. Talk about what you and Robert are doing. Tell these people.
You, Robert, and I, we all came from humble beginnings.
You and I both became millionaires before our 30th birthdays, right?
That's true.
But what if you didn't have to punch a clock or start your own company to achieve that life-changing windfall?
Wow, I mean, imagine having people like us, self-made millionaires, helping you get into business deals that you couldn't get into before or on your own. It doesn't involve stocks or options or cryptocurrencies or real estate, and I'm going all in on this.
The reality is that angel investing is extremely risky. It's literally investing in companies at the riskiest point of the business when it's just starting up. Well over 90% of startups don't perform as well as expected, and most fail outright, making your investment worthless. Even the richest, most well-connected, brilliant angel investors with decades of experience anticipate 9 out of 10 of their investments will fail. The goal is to get that 1 out of 10 to have such massive returns that it offsets the 9 out of 10 that are big losses. For an average person who doesn't know what they're doing and doesn't have the experience, angel investing is so risky that it's almost like playing the lottery. You don't need to spend thousands of dollars in fees to gamble all your money away. And going back to what Jason Calacanis said, does it make any sense to give them thousands of dollars so they can help you make millions with little risk? No, the risk is going to be there. It's not going away. And you got to think, if there really was an opportunity to go up 1,000x with a disproportionately low amount of risk, like, do you think they would be sharing that with you? Does that make any sense? No, they'd be doing it all themselves. This thing, it reminds me a lot of the gold rush, right? The people mining for gold, for the most part, wasn't making any money. Very few people actually made money getting gold out of the ground. The people that actually made all the money was the ones selling shovels, selling equipment, providing lodging, providing clothing to the gold miners. Those were the people that made all the money. And this is what it seems like. This is kind of what this whole rush to do angel investing feels like. That, this law opens up opportunity. The whole public's able to do it now. So now all these platforms are trying to kind of sell you on the dream. And they get their money up front. In this case, they get $5,000 up front. Bruh. And you take on all the risk. And another thing, does it make any sense that if, let's say you're making 100 grand and you're an unaccredited investor, you're limited to only invest $5,000, okay? So if you're spending $5,000 in a subscription and then you can only invest $5,000 per year, you literally have to double your money. You have to do more than that because there are going to be fees. You have to more than double your money just to break even. Bruh. Okay. So I don't know. It just seems like a internet marketing thing to me, but who knows? Let me know what you think about it. Maybe someone watching this has actually tried angel investing with these guys, and let me know what happened with you. Let me know what your experience is. Yeah, and if you liked the video, leave a like, and I'll catch you on the next video. Peace.